rarely is the person who is the loudest in the room or seems to be the most confident ever the one who is always the most right. And today we are going to have a little fun. We're going to break down one of these types of characters and really take a look at why Dave Ramsey's wrong in a number of different ways as it pertains to whole life insurance, and not only whole life insurance, but also the infinite banking concept. So bear with me. We're going to dig in. We're going to listen to a little bit of this stuff, if you will, and we're going to have some fun with it. We're going to learn a little bit along the way and see just where Dave has gone wrong at telling potentially millions of people incorrect types of information. So as we get started here, a couple of things I want to talk about to just give a lay of the land. So we have a caller who's calling in. They pay $680 a month for whole life insurance premiums for both him and his wife for $1.5 million in coverage. That's roughly $8,160 annually in total premium. And he's calling in to ask Dave about some advice. And first and foremost, what you're going to see right away on the screen is whole life being compared to an investment, which is completely incorrect. Whole life insurance is insurance. It's an insurance product. It's not intended to be an investment. It's intended to be a replacement of income and a store of capital. But more on that in a minute. Let's just get into the video here.
Main companies that sell whole life, the numbers break down about like this. Per $100 that you pay in premium, you can buy the same amount of term life insurance, 15-year level term, 20-year level term, for about $5.
Got it.
It's roughly 20x. Okay. And for the insurance, obviously whole life, though, has another component to it that term does not have. You're obviously aware of that. You spend a lot of money on this. And that other component is a cash value buildup. Now, the cash value buildup is the other $95 out of $100 approximately. Could be $91, could be whatever, but it's somewhere in that range. Nationally, across the top 10 whole life insurance companies, it is $95.
All right, so let's take a look at what Dave has stated here. So as I mentioned, first and foremost, whole life is not an investment, nor is any other type of insurance. One of the things that we find here early on is that we're looking at, or kind of Dave's setting up the comparison between term and whole life. So are they both insurance? Yes, but there is a fundamental difference between them. Term operates much like your car insurance, your homeowner's insurance, anything like that. It's insured for a risk if something happens, whereas whole life is when something happens. So there is a definitive difference. The company is structuring the premium, structuring everything because they know they have to pay the death benefit. So that is completely different than maybe what a lot of people tend to think about it with insurance. They're not thinking about it as that it will be paid out. There is a fundamental difference between the two. Term and whole life, yes, term is going to be less expensive because why? Number one, term insurance pays out roughly 1.5 to maybe 2% of claims out of all policies in force. And that's across the entire industry. So it's pretty significant. Secondly, whole life is going to pay out. So in this case, you have this husband and wife, you have $1.5 million of total death benefit that will be paid out to their beneficiaries at some point in time. Whereas if it was term, and Dave referenced 15-year level term, 20-year level term, if this guy's 35 years old and he goes 20 years on a term policy, at age 55, if he still needs term insurance, how much do you think that death benefit's going to cost at age 55? It's going to be a lot of money. So that term cost rises exponentially as a person gets older because your risk to the insurance company goes up significantly. Whereas whole life is a level premium, it never goes up, and it continues to stay at the same level depending upon when you get insured, and it's always going to pay that death benefit. Now, the other thing Dave was touching on here was cash value. And we'll talk more about it in a second as we switch back over to the video. But one of the things I want to call out here too is that Dave is referencing specifically when he's talking about the top 10 companies, he is talking about stock insurance companies. Stock insurance company, whole life insurance operates completely different than mutual insurance companies. And those of us who are operating, particularly those who are authorized infinite banking practitioners through the Nelson Nash Institute, we are utilizing whole life insurance through a mutual dividend paying whole life insurance company. And that is a fundamental difference in the product, the structure, and how things work, because that death benefit that you get on day one is only going to go up from there because of the dividend structure and the guaranteed growth that takes place in the contract. So again, a little different here, but let's transition. Let's get back to the video and take a look at a couple of things that Dave has to say here.
Whole life insurance, and it's not a mild dislike, I hate it, is that what happens to that $95. And in cash value, what you will do, and you're well past this, but if you went back and looked at your policy pages, your cash value buildup for the first 3 years, your savings buildup is zero. 100% of the $95 goes to fees. It's front loaded as an investment, which in and of itself is not necessarily evil. It's just frowned upon in the financial planning world by and large. The second thing is that once you do start building it nationally, and again, don't know your policy, but it's not going to be substantially different. The average rate of return on the $95, if you look at your actual cash value buildup, including the 3 years of zeros on the front end, it ends up being an average of about 1.2%. Let's be generous and say it's double that, 2.4%. Still not a good long-term investment. If I could get 2.4 on my money market, I'd be dancing a jig, but not on my long-term investments. My long-term investments need to be north of 10% to be beating inflation and taxes. And so it's a horrible.
All right. So we see Dave here stating that he hates whole life insurance. And, I can't necessarily blame him in some respects because he's being very limited on his view of it. He like I mentioned before, he's only looking at stock insurance companies here. And a stock insurance company's whole life insurance policy just does not operate all that great for a person from an investment angle. Again, it's not an investment. So I don't know why we even make these comparisons. And I think a lot of it is just because where it all comes from really stems back to people who were selling or wanting people to invest into the market. And they're like, well, if I get somebody to do term insurance, I can get more of their money into my assets under management by having them put more money into the stock market. And while that sounds like it could be a good thing, there is a lot of inherent risk that comes with that. In a whole life insurance contract, you have a ton of guarantees. And I just want to reiterate, when I'm talking about whole life, I'm talking about dividend paying whole life insurance through a mutual provider. The products just operate differently. The dividends that are accumulated in the contract, while they're not guaranteed, these companies have been paying them for well over 110, 120, 140 years consistently with no misses in over any of those time frames. So you have this accumulation of dividend taking place over the course of time, and that death benefit is consistently growing over that time frame as well. So it's because of those dividends and because of that process, you actually do have cash value accumulation significantly earlier in a contract than maybe what you would even think of. And I was looking at a policy design recently where there was, anywhere from 70% cash value accumulated within the first year. Now, that's not always the way that we're going to structure something, but that is an example of where you can have higher cash values accumulate within a contract somewhat early, but like anything, it is an engineered product, meaning it's put together by actuaries. So you do have situations where if you pull one lever too high or move one thing versus another, you're going to see it's going to impact the contract in a different way, whether that's the dividend accumulation, cash value growth, the amount of premium a person can pay over time. So just something to keep in mind there. But, again, Dave's looking at this, comparing a protection product against investing. It's just flat out wrong. Like, you don't do that. I don't go and say, oh, how can I compare my auto insurance against an investment? I mean, it doesn't make any sense, right? The way he's approaching things doesn't make a whole lot of sense from that standpoint. You wouldn't do that in any other facet of your life, really. All right, so let's jump into a different part of the video here and take a closer look at what Dave has to say, which, quite frankly, I find is rather funny and a misunderstanding, but we'll dig into it in just a second.
At 2.4% that you put $95 per 100 in to get to 200,000 or to get to 100,000, none of that. So you have a savings account that for the first 3 years you put in there gives you nothing. After that, it pays 2.4%, and when you die, they keep your money.
All right.
Which makes it absolutely horrendous. So you're much better off. And many, many decades ago, the financial planning community, by and large, started moving towards buying term life insurance for the $5 per 100 and doing almost anything else with the 95, but over in the investment world, away from the insurance world. You put it in a freaking fruit jar. At least it's there when you die.
Okay, so you said would your advice be to just terminate those policies and just do what you suggested, purchase relatively inexpensive term life policies and then put additional money? I mean, I do have investments. I mean, I could just up those investments. I invest into mostly directly in the S&P 500. I've got a 401k.
Exactly.
So would you
but get the term life in place first.
Yeah, exactly. Get your term in place.
All right, so yeah, this is just frankly really, really bad advice. First and foremost, let's talk about just the insurability aspect of it more than anything else. Let's say this guy, as he has, gone out, he's gotten these policies in place. He has guaranteed his insurability between now and when he passes away. So those contracts will pay out a death benefit when he passes to his family, tax-free. No ifs, ands, or buts. It's a guaranteed unilateral contract so long as he pays the premium. So if he were to go out and get term insurance, he is removing that current insurance that he has in place, and he has to go through a new underwriting process. What if between the time he got these and the time he's going to get term insurance, he develops a condition? Or later on in life, he develops a condition and he's no longer insurable. I mean, that stuff happens. It's very real. I have worked with clients who've had insurability issues, and it is a very real thing. Life insurance is a privilege more than it is a right, because you can only get so much, and you can only get based upon your current health. Now, I want to take another dig here into what Dave's saying, in that they keep your cash value and all you get is the death benefit. Like, I don't understand where that's a problem. You're paying a premium for a product and they're going to give you more than what you paid in. In this case, it's significantly more, almost 3.5 times more what you paid in premium, assuming this guy lives to say age 80, assuming he's age 35. That would be roughly $360 some thousand in premiums he would have paid, but he also would have had contractual access to the cash value all along the way to be able to do whatever he needed to do with it. So Dave acts like the money's locked away and you can't do anything in a whole life contract, and that's a big problem. That is a complete misunderstanding of whole life. You, as the owner, have access to the cash value. You can use it in any way, shape, or form generally speaking, that you would like to, if you choose to access it. Now, it's more so like capital accumulation than it is premium. But again, little different. I have other videos on this, so please feel free to take a look. That being said, I would appreciate it if you do like and subscribe. It'd be great to, if you like this type of content, I have more available, and it'd be great to hear from you. Anyway, the other aspect that I have an issue with here is that Dave's misunderstanding the fact that cash value is simply the current equity that somebody has built up within a whole life insurance contract. So as you pay premium, you get access to cash value, and that is your net present value of the death benefit available to you. And that cash value grows. I have seen, and I personally have policies in which that first year, second year, third year cash value operates nothing like what Dave is talking about. Because again, Dave is only talking about these top 10 stock insurance companies. He is not talking about mutual dividend paying whole life insurance companies. And if they're properly structured for the infinite banking concept, you're going to have cash value available right away. So this isn't like putting away your money and locking it up and it's gone forever. That's actually what Dave's telling you to do by putting your money into the market. The other big thing that I really have to point out here is Dave says you're better off putting the money in a fruit jar. Are you kidding? I mean, think about that. I just stated after 45 years, it'd be $367,000 in premium that this guy would have paid in. If you put it in a fruit jar, you would have lost all of the money through inflation that money could have, obviously could have been holding with. But also, it's only $367,000, whereas the death benefit is $1 million, and that's only on the husband's contract. So it's $1.5 million if you count both contracts. $1.5 million for $367,000. Again, Dave's math isn't mathing here, so it's just something to really consider. Again, these whole life is a when, not an if. And that is a big distinction that so often gets blown over or missed within the insurance industry. So the last thing that Dave talks about in this video, and I'm not going to go into it here, but he talks about that you don't need life insurance later in life. Well, I would argue that you probably still do because of some of the changes that have taken place in a lot of these different types of tax qualified plans and things like that. Let's say a 401k, for example, somebody accumulates a lot in there, they pass away, it goes to their beneficiaries. Well, depending upon where someone's at in their income earning years, let's say you're in your mid 50s, your parent passes away, they had $2-3 million in a 401k. Well, that has to be drawn down within 10 years, and you must withdraw it. The federal government, through the Secure Act, requires you to draw down those funds. So if you're right up to a tax bracket and now you have to withdraw out of this 401k as a result of the Secure Act, now you're going to increase your total overall taxable income in that year and have to pay even more in taxes. So you've actually created more of a tax time bomb for people for your beneficiaries, as opposed to providing them a huge tax-free windfall, which is what life insurance does. And so again, just to recap in this video, Dave's wrong on a lot of different points here. He is completely misguiding people when he tells them to cancel contracts for so many different reasons. I would highly recommend, if you have any type of permanent type of life insurance, to work with a really good advisor to walk through your options if you are considering liquidating that in any way, shape, or form. There are many ways to avoid a significant problem in doing that when you work with somebody who is qualified to operate in that space, including myself and many others with the Nelson Nash Institute. So as we wrap up here today, it's important to remember that the person who speaks the loudest and maybe the most confidently isn't always the person who's right. And it's important to vet out some of the things that are being stated by such talking heads who aren't licensed, they don't have any skin in the game, and are telling you what to do with your money. I would highly recommend that you work with a qualified advisor, somebody from the Nelson Nash Institute, somebody like myself, or any others. But as I wrap up here today, I want to consider doing more content like this. If you like that, please hit like, subscribe. Please provide comments. Let me know if you want to see more videos like this. And we'll talk to you again next time.